Hi everyone. We've learned the concepts under Ind AS 16 property, plant and equipment. We would now like to apply that learning with the help of the questions and case studies. We are provided with this information where it says that Beta Limited has incurred the following costs for installation of a new plant. The plant cost as per invoice including taxes, delivery and handling costs, site preparation cost, consultant's fee for advice on the acquisition of the plant, interest charges paid to supplier of plant for providing deferred credit terms, estimated dismantling cost to be incurred after 7 years, the present value of that, and operating losses before commercial production. The question is requiring which costs can be capitalized by Beta Limited. Now, the moment I hear this requirement, what we would now like to remember is that what is the concept under Ind AS 16 that helps us know the value of an asset on its on its initial recognition. What is the value, what is the cost of the asset to be recognized on day one, right? We would like to remember that the cost of an asset includes the purchase price, any directly attributable costs, and other costs. All right. So I may want to call it a PP. I may want to call it a directly attributable DA. And here I refer to as other cost as OC. Okay. Just for the remembering purposes, right? Now, what is all included in purchase price? We say the price that you pay to acquire the asset, the amount paid for the acquisition of the asset, plus any non-refundable taxes, right? The directly attributable cost would include all those costs which are directly attributable to bring the asset to its present location and condition. That's the requirement. That's the measurement criteria, which means that all those costs without which the asset cannot be used for its intended purpose. I'm buying a plant. So the delivery charges, site preparation, consultant fee, those list of examples could be a relevant information for me. And how about the other costs? Within the other costs, I would include any dismantling charges. The present value of those dismantling costs, site restoration fee, etc., would become a part of my other costs. So if I really go back to the questions requirement and the information, we would be able to assess that the plant cost being a part of the purchase price, which is 2,50,000 rupees, is included in the cost of the asset. Delivery and handling costs, which is your directly attributable cost of 20,000 rupees, also becomes a part of the cost of the asset. And this is also applicable to site preparation costs. So 60,000 will be added. Consultant's fee on the advice on the acquisition of the plant of 70,000 rupees is also an example of a directly attributable cost. If you look at the next information, interest charges paid to supplier of plant for providing deferred credit term. The supplier is saying that don't pay today, you pay it later, but you pay extra because you're buying time. It is not towards the asset. It is towards the time that you are taking to make the payment for the asset. Now, this extra payment, this interest cost does not contribute to create the asset, which means that this is not going to be added to the cost of the asset. All right. The next line, it says that estimated dismantling costs to be incurred after 7 years, the present value thereof. It's an example of other costs, what we mentioned. So this 30,000 rupees is also added to the cost of the asset. And finally, operating losses before commercial production, they are purely operational losses. They are purely operational expenses. This is specifically excluded to be capitalized. All right. So what we have got is the purchase price, directly attributable costs, and of course, other costs here, right? As far as the interest charges and operating losses are concerned, we say that interest costs or interest charges and operating losses are charged to statement of profit or loss as period costs, right? That's how try to understand the requirement of the question and categorize those, different expenses in terms of what should be capitalized and what should be charged to the statement of profit or loss. All right. With this thought, let's have a look at the formal solution here. It says that according to Ind AS, these costs can be capitalized. This is the purchase price. These are directly attributable costs, and this is an example of other costs. And as far as the interest charges and of course the losses are concerned, they would be simply charged to the statement of profit or loss. We are provided with this information where it says that PQR Limited in its balance sheet has an item of plant whose acquisition cost was 10 lakh rupees. The company had carried out a revaluation of the plant, and the revised valuation is 6 lakh 50,000 rupees. The accumulated depreciation on the date of revaluation is 5 lakh 50,000 rupees. What is the requirement of the question? It says that provide the entries due to revaluation as per Ind AS 16. The moment I hear this term revaluation, I know the revaluation would be either an upward revaluation or a downward revaluation. So it's important to first of all assess that part, right? Now, why it's important? Because I know that if it's an upward revaluation, I would land up creating a revaluation surplus. But if it's a downward revaluation, I have to book a loss in the books through the statement of profit or loss. All right. So what is the value that we are getting when this revaluation is happening? What is the value of that asset on the date of revaluation? We are provided that the cost of the asset is given as 10 lakh rupees. The accumulated depreciation is given at 5.5 lakh rupees, which means that the carrying value or the carrying amount of the asset is 4.5 lakh rupees, right? This is the value, this is the base value against which the revalued amount will be compared. And the revalued amount, by the way, is given at 6.5 lakh rupees. Now, what does it mean? It simply means there is an upward revaluation, that is a revaluation surplus of 2 lakh rupees, right? That is where we start preparing or building or structuring our answer. That first thing that we want to do is bring the assets cost to its carrying value. That's the first step that we want to do. And then compare this carrying value versus the revalued amount and build that entry to upward the value of the asset to 6.5 lakh rupees, right? So the entries would be, the first transaction that I need to do is, I would say, reduce the value of the asset by 5,50,000 rupees, and I would eliminate the accumulated depreciation to the extent of 5,50,000 rupees, right? The relation would be simple: elimination of accumulated depreciation, which is 5.5 lakh rupees. The other entry is, of course, creation of the revaluation surplus, which means that I will debit my asset 2 lakh rupees and credit revaluation reserve or revaluation surplus to the extent of 2 lakh rupees, where we say that the asset being revalued or revaluation of the asset. Of course, in our example, it's a plant, so we can use that as a more logical reference in terms of explaining the entries there. All right. Let's have a look at the formal solution where we have provided that the entries to be passed would be accumulated depreciation 5,50,000 rupees to plant account, elimination of accumulated depreciation against the cost of the plant, and then plant account to revaluation surplus 2 lakh rupees being increased due to the revaluation of the plant. Right? We have provided the information which says that Good Luck Limited in its books has an asset with an acquisition cost of 20 lakh rupees with a residual value of 2 lakh rupees. At the time of acquisition, the management estimated its useful life to be 10 years. At the end of year 8, the management has carried out a review of the asset's useful life and residual value. The revised residual value is 1 lakh rupees and the revised estimate of useful life is 12 years, including 8 years lapse, which means that there's remaining 4 years. The question's requirement is what should be the impact of above changes to depreciation? Now, you would like to remember here, the moment we hear term depreciation, we start talking about, what is the depreciable component of that asset? Okay, we are given this. The depreciable component is cost minus residual value divided by expected or estimated sphere. We are provided with the information which says that Good Luck Limited in its books has an asset with an acquisition cost of 20 lakh rupees with a residual value of 2 lakh rupees. At the time of acquisition, the management estimated its useful life to be 10 years. At the end of year 8, the management has carried out a review of the asset's useful life and residual value. The revised residual value is 1 lakh rupees and the revised estimate of useful life is 12 years, including 8 years lapse, which actually means remaining 4 years. The requirement of the question is what should be the impact of above changes to depreciation, right? The moment we hear the term depreciation, we start looking at what is a depreciable component. Are we depreciating the entire asset's value, or are we considering also the residual value for that? Well, by the way, we do consider that, which means that I'm looking at the cost of the asset minus the residual value, and that gives me 20 lakhs minus 2 lakhs, which is 18 lakh rupees. Now, this is what is going to be depreciated over the expected life of 10 years, right? Which means that my annual depreciation before the changes in residual value and estimated useful life, that will be 18 lakh divided by 10. That brings me 1,80,000 rupees per annum, right? So I would continue to charge this depreciation for 8 years as such, which means that for the next 8 years up to the end of year 8, my total depreciation will be calculated at 1.8 lakhs into 8, and that will be 14 lakh 40,000 rupees. Okay. Now, at this point in time, there is a change in both the residual value and the estimated life. Okay, which means that at this point in time, I need to again calculate my depreciable component, which would be measured at now, because the cost is gone, it's the carrying amount minus the residual value. Now, what is the carrying amount here? We already know the cost as 20 lakh rupees, but 14 lakh 40,000 rupees was already charged in the form of depreciation, right? And the revised value is given as 1 lakh rupees to us. If we really go back there, this is the value that we want to pick up. Okay, so this makes it 20 minus 14.4, that would be 5.6, minus 1 lakh would be 4 lakh 60,000 rupees. Okay, now my estimate of revised useful life, which means that my annual depreciation will be the depreciable component, which is 4.60 lakhs, divided by 4 years, and that gives me my revised annual depreciation to be charged at 1 lakh 15,000 rupees, right? The way we want to explain this concept as a recognition principle, that a change in residual value or estimated useful life is a change in estimate under Ind AS 8. Okay, which means that therefore the depreciation will be charged on a, I rather would say the revised depreciation will be charged on a prospective basis, which is for the next 4 years, I will be charging a depreciation of 1 lakh 15,000 rupees. All right. Let's have a look at the formal solution, where we're given that the change in the residual value and useful life will be affected in the following manner. Depreciable amount, which is cost less residual value, that is coming to 18 lakh rupees. Annual depreciation would be 1.8 lakh rupees. Total depreciation for 8 years will be 14 lakh 40,000 rupees. And then the carrying amount, of course, is calculated 5 lakh 60,000 rupees, because the remaining life is also changed, to 4 years now, which means that the revised depreciable amount is 4 lakh 60,000 rupees, and my annual depreciation will be calculated at 1 lakh 15,000 rupees. All right. Thank you very much. We are provided with the details where it says that as of 31st of January 2021, Zeta owns a machine with a carrying amount of 10,000 rupees, which is damaged due to fire. The damaged machine is sold by Zeta at a scrap value of 1,000 rupees. Zeta has taken an insurance on the machine, and as at 31st of March 2021, the insurance claim is in process, but the same has been confirmed by insurance company. All right, and the insurance compensation agreed is 5,000 rupees. The question's requirement is, how should the above transaction be recognized by Zeta for the year ended 31st of March 2021? Right? Very clearly, there are two scenarios, there are two aspects within this question. One is there is a damage to the machine and there is a loss on the disposal. So there is a loss on disposal, which is 10,000 minus 1,000, and that comes to 9,000. And there is a compensation against the damage, which is 5,000 rupees. So we have a compensation in lieu of that damage, which is 5,000 rupees, right? The question's requirement, of course, is how should the transactions be recognized? Very simply put, should I adjust this, 5,000 rupees of compensation against the loss, or should I show these two items separately, right? Now, very clearly, we're talking about the concept of offsetting here. So there's a loss, let's put it in a bracket. Should we be permitted, or are we allowed to offset these two transactions, right? Very specifically, offsetting is only permitted if it is legally allowed, right? And normally in such kind of transactions, wherein we have a damage, let's say, to an asset versus the compensation, okay, against that particular damage to the asset, they are normally not allowed to be offset with each other, right? These are considered as two separate transactions, right? So from that perspective, from that thought, what we want to say here is that there is a damage of 9,000 rupees versus there is a compensation of 5,000 rupees. These are not allowed to be offset or adjusted against each other, shall be treated as two separate transactions, which means that the loss of 9,000 will be shown separately from the compensation of 5,000 rupees. Now, why are we going to kind of recognize this 5,000 rupees as an income or a compensation? Because the amount has been confirmed by the insurance company. Okay. Had it not been confirmed, then we would not even have recognized that income or the compensation. It would have been a contingent asset under Ind AS 37 that you would study, of course, in Ind AS 37 provisions, contingent liabilities, and contingent assets accounting standard. So what I was trying to say is that these two items are shown separately and not adjusted against each other. All right. Let's have a look at the formal solution. We are provided with this information where we say that the damages or impairment to property, plant, equipment, and the related insurance claim or compensation are two separate transactions, okay, and should be recognized separately in the books of accounts. Therefore, Zeta would account for the transaction as the disposal of machine at the time of scrap scale. At the time of scrap sale, the company should de-recognize the machine and recognize a corresponding loss of 9,000 rupees. And as far as the insurance claim is concerned, the compensation of 5,000 received should be recognized as an income in the statement of profit or loss. Okay. We are provided with the information about a company, Omega Limited, which suggests that Omega Limited owns a nuclear power plant, which has been operational since 1st of April 2011 and has a useful life of 40 years. So let's mark the dates as we read. It has decommissioning liabilities in relation to the same. The plant's acquisition cost was 12 lakh rupees, including 1 lakh rupees towards the cost of decommissioning the plant at the end of its useful life, which represented rupees 7 lakh 400 in estimated cash flows payable after 40 years, discounted at 5%, right? This discounted at 5%. And of course, this 1 lakh rupees is given as a part of the cost of the asset. Now, this is, of course, the present value of dismantling. In our case, we can use the word decommissioning. Right? This is the present value of dismantling or decommissioning cost. And as per the understanding of the definition of the cost of the asset, the present value of that dismantling cost is added to the cost of the asset. And that's the reason why this 12 lakh includes this 1 lakh rupees. Okay. It also mentions further, Omega Limited has a financial year as ending as 31st of March, and as on 31st of March 2021, the decommissioning liability is measured at 1,63,000 rupees. There are some technical changes, technological changes, as it is mentioned. So 10 years from the start, the decommissioning liability is now evaluated at 1,63,000 rupees. Okay. But at the same day, on the same day, on 31st of March, the decommissioning liability has decreased by 80,000 rupees. There's no change in discount rate, and it's also provided that the company follows cost model. So what are we understanding from here so far is that in the books we have this decommissioning. So the carrying value is 1,63,000. Okay, but this has decreased by 80,000, which means that the revised value is 83,000 for us, right? The company follows cost model, and it says that how should Omega Limited account for the changes in decommissioning liability for the years ended 31st of March 2021 and 31st of March 2022. Okay, so the first thing first that you want to remember here is that the liability has reduced by 80,000 rupees. Very simply put, in this case, I would debit my decommissioning liability. It's a reduction in the liability by 80,000 rupees. Okay, where do I take the credit? Now, in this case, what you want to remember here is that any changes in the decommissioning liability with a change in the estimate thereof would be adjusted against the value of the asset. And that is where, by the way, we had created that liability, into the value of the asset itself. So the reversal of that estimate is also being taken through the asset, which in our case is the plant. And this is the first transaction. This is being revision of decommissioning liability. Okay, this is the entry that we are doing on 31st of March 2021. That takes care of, for example, our first requirement here. Okay, now what are we supposed to do is we are supposed to look at the year ended 31st of March 2022. Importantly, what you would like to remember here is that your original cost of the asset was 12 lakh rupees. The decommissioning liability is now measured at 163, and of course, it has been reduced to 83,000. This is the calculation that we have done so far. Okay. What you would like to remember here is that the cost of the asset is 12 lakh rupees. 10 years have gone by, from 1st of April 2021 to 31st of March 2021, right? From the 1st of April 2011, 31st of March 2021. So what you would like to remember here is that the cost of the asset is given at 12 lakh rupees. The value of the asset has been depreciating. The asset has been depreciating against the life of 40 years. 10 years are already gone by. Okay, so essentially we need to remember that if there is a cost of the asset which is 12 lakh, I would have already charged depreciation for 10 years, which is 12 lakhs into 10 by 40. Now this would be 3 lakh rupees. That gives me the value of 9 lakh. This is the carrying value of the asset after depreciation. Okay, as on 31st of March 2021. But also there's a reduction in decommissioning liability, which is 80,000. That gives me the value of 8,20,000. Now this becomes essentially the carrying amount of the plant. This is the carrying value of the plant on 31st of March 21. And now and onward, add this value, I will be charging my depreciation. Okay, so my remaining useful life is 30 years, which means that my annual depreciation will be 8,20,000 divided by 30. Let's do this calculation on the bill. Eight lakh 20,000 divided by 30. So let's do this calculation on the calculator. So that would be 820 divided by 30. That gives 27333. So this is the depreciation for the year ended 31st of March 2022, which is 27333. And the finance cost on the decommissioning liability. Okay, remember my decommissioning liability is given at 83,000. Okay, I need to charge the discount. The unwinding of discount will take place, which is 83,000, by the way. That will be 83,000 into 5%. That gives me a value of 4150. Right? That's how you start structuring your answer. That's how you start doing your calculations to be able to explain the requirement application. Going back, we have this reduction in the value of the plant by 80,000, of course, with the reduction in the decommissioning liability to that extent. And of course, we also have the depreciation to be charged for the next year, as well as the finance cost to be charged for the year ended 31st of March 2022. Right? So let's have a look at the formal solution. It says that as at 31st of March 2021, the nuclear plant has completed 10 years. Accumulated depreciation so far for the 10 years period is 3 lakh rupees. Now, since the decommissioning liability has increased from 1 lakh, the original value of the decommissioning liability was 1 lakh, it has increased to 163. This is the information given in the question. Now, so there is no change in the discount rate. Due to technological changes, there is an estimate that the present value has decreased by 80,000 rupees, which means that I have to bring the value of the asset as a reduction to that. And that is where this entry has taken place on 31st of March 2021, right? That is the first part of the solution. For the next part, we are saying my revised value of the asset will be 8,20,000 rupees, which is 12 lakhs minus 3 lakhs minus 80,000 rupees. And this is depreciated over 30 years. This is the rounded figure, 27330. We had calculated 27333. This is also, of course, used. And the interest cost of the finance charges I need to calculate would be on that revised estimate of the dismantling cost, which is 83,000. And I'll be calculating 5% on that, which comes at 4150. We are now given this scenario. Omega Limited owns a nuclear power plant which has been operational from 1st of April 2011 and has a useful life of 40 years. It has a decommissioning liability in relation to the same. The plant's acquisition cost was 12 lakh rupees, including 1 lakh towards cost of decommissioning the plant at the end of its useful life, which represents 7 lakh 400 in the estimated cash flows payable after 40 years, discounted at 5%. Omega Limited has a financial year end at 31st of March. Assume that the market-based discount cash flow valuation of 11,50,000 rupees is obtained at 31st of March 14, which includes an allowance of 1,16,000 for decommissioning costs after unwinding for 3-year discount, which represents no change to the original estimate. Further, on 31st of March 15, Omega Limited expects a decrease in decommissioning liability by 50,000 rupees due to technological advances. Omega decides to do a full valuation of the plant on 31st of March 15 to ensure that the carrying value does not differ materially from the fair value. The asset is valued at 10,70,000, which is net of an allowance for reduced decommissioning obligations. Omega follows revaluation model. The question's requirement is, how should Omega account for the changes in decommissioning liability of the plant? So much of information, right? So it's a good idea to split this information into several parts and then proceed with the requirement. We are given the first thing that Omega Limited follows revaluation model, right? That's one thing that you want to remember. Second thing that is provided is that the cost of the asset is 12 lakh, which is including 1 lakh of decommissioning, right? Which probably, if we were to split this cost into two components, we are saying that the cost of the asset is 12 lakh, which is basically 11 lakh that would have been paid plus 1 lakh of decommissioning liability, right? Now, this is of course on 1st of April 2011, right? Now, importantly, this is getting revalued again. If you go back on the question's requirement, it suggests that on 31st of March 14, there is a valuation done. There is a market-based discounted cash flow valuation done of 11,50,000, including an allowance of 1,16,000. Now, precisely, let's look at this figure first, 1,16,000. Okay, you would remember that if this decommissioning liability is present as a part of the cost of the asset, okay, importantly, this decommissioning liability over the 40 years, right, is expected to become 7,400,000 using a discount rate of 5%, right? We're not supposed to do this calculation, of course, but this is what a decommissioning liability is effectively trying to mean, okay, which means that now from decommissioning liabilities perspective, this will increase in 1 year at 5% and then becomes 1,05,000, right? Again, so using a 5% discount rate, which is year one. Again, if you use this rate, that would be 5250 and then becomes 110,250. That is year two. And then this would probably be 5,500 approximately. This is year three, right? That becomes 115,750, which is approximated to 1,16,000, right? Now, what this 1,16,000 is nothing else but the amount of decommissioning cost unwinded. And this is where we are able to confirm that it represents no change to the original estimate. Our original estimate is actually speaking 1,16,000, which is the rounded figure of this 115,750 to the nearest thousands, of course. Okay. Now, if the question suggests that on 31st of March 14, you're doing a valuation of the asset at 1150, including an allowance of 116, that precisely means, right? That precisely means that the revalued amount is basically 11 lakh. Let's go back to the figure, 11,50,000. Okay. Plus 116,000. Now, this would be, of course, 12,66,000, which represents the revalued amount on 31st of March 2014. All right. Now, against this, what is the carrying value? That's what we need to determine. We are given that the cost of the asset is 12 lakhs. Okay. Now, if I were to depreciate it for 3 years, and the remaining, the total useful life is 40 years, it simply means that would be 12 lakh into 3 by 40. That gives me 90,000, right? which means that the carrying value of the asset on 31st of March 14 is 11,10,000, against which the revalued amount is coming at 12,66,000. Now, what does it mean? It simply means that I need to do the first revaluation, which is from 11,10,000 to 1266. Now that would be 1,56,000. It's a revaluation upward, so we will be doing that accounting as well, right? Now, it further suggests that on 31st of March 15, the decommissioning liability has reduced by 50,000 due to technological advances, and eventually the full valuation of the asset is being done. Now, the moment we say there is a reduction in the decommissioning liability, okay, so if we were to understand this decommissioning liability, we were looking at the total decommissioning liability of 116,000. Let's carry this forward. This is, by the way, as on 31st of March 14. So we are saying that my decommissioning liability is 116, right, on 31st of March 14. Okay. Then I would add another 5%, which would be approximately 6,000. That makes it 1,22,000, right? Now, this decommissioning liability, as per the requirement of the question, is reduced by, right? It's reduced by 50,000, which means that my decommissioning liability remaining will be 72,000. And this reduction of decommissioning liability would be, of course, taken through revaluation surplus, because if the asset were to be taken at its cost method, this reduction would not have been able to, accommodate it to its original cost itself. That's the reason why we're using this revaluation surplus. All right, so that's how broadly you understand the requirement of the question, and you're able to kind of pick up these numbers to be able to, let's say, do the accounting thereof. Okay, let's have a look at the formal solution on this. It says that on 31st of March, as at 31st of March 14, we had picked this value of 12,66,000, and we had, of course, the decommissioning liability of 1,16,000, which gives me the value of the asset as 1150, representing a revaluation surplus of 1,56,000. Okay, now this is a reference of 106, which is retained earnings. This is nothing else but my total depreciation and my finance cost on the decommissioning cost, which is charged for these 3 years, right? And for the for the fourth year, we are saying that the decommissioning liability would be 1,22,000. We had calculated that before. And of course, on this 1266, my next year's depreciation will be on the remaining 37 years, which is calculated at approximate figure of 34,200. Okay. Of course, the further information suggests that the whole of the adjustment is taken through the revaluation surplus because it would not exceed the carrying amount. Okay, and accordingly, this is the accounting entry that we do as far as the reduction of the decommissioning liability is concerned. And finally, on 31st of March 15, we revalue the asset at 10,70,000, which is the net figure on the decommissioning liability. It was 122. We reduced 50 out of that as a part of the requirement application. All right. Thank you very much.